question and answer at the end. So let's Susan get through this presentation, then we'll do a question and answer. Take it away.
All right, all right. So I'm Susan Wiklow. We have an office up on North North Union, and if when we get to the end, you'll see it, and that is a property that one of our entities owns. And so, one of the reasons I like working with realtors and people in real estate, whether they're single-family home buyers, fix and flip, creative financing, whatever it is. I've experienced a little bit of almost all of that during my life. So, still have a few rentals. I have one out of state right now that we love down in Florida on the beach. So, don't get down there as often as I'd like, but tons of fun. So, finding ways to be able to take advantage of things like that, that's what we like to do and help people do. So probably most of you don't realize tomorrow's a deadline for us. I think my staff thought I must have been drinking when I said yes because I'm like, oh my gosh, I have to run out and do this presentation. But tomorrow, if you do have a business entity and you haven't filed, if you have a 1065, a partnership, or a 1120S, which is an S corp, they are due tomorrow if you didn't file back in March. So anyway. So I like to make this a little bit fun. Hopefully you'll find some interesting facts, but we're just going to start out with I found this information um, a year or so ago, and I just found it interesting, and hopefully you'll find that too. So I think most of you maybe know this today, but McDonald's didn't make all their money by flipping burgers, but actually locating their businesses on major intersections and buying the real estate. And so for them, they have a huge portfolio. How many of you knew this was part of their how they made? So good, good. So it's great to have some people who know about that. Oops, sorry, going the wrong way. So have any of you ever heard of Warren Buffett? So, multi millionaire. And this is being one of the richest men in the world. He still lives in the same house that he bought when before he made his millions of dollars. I find that really fascinating. Most people, buy up once they get, more money, but and he only paid $31,500 for it. So for you who are fix and flippers, anybody fix and flip in this group? No? Well, you might want to know this, that brass doorknobs disinfect themselves. So there's some metals that do that. I know. Isn't that crazy? So it's the metal, and so it's not just brass, copper, aluminum, iron, lead. They all have um, a material in them that helps kill the bacteria. So there's a nice little tidbit you can talk about at the bar afterwards. So this one, I did look this up. I don't quite understand how this all happened, but there's a guy who had this paper clip that he kept trading till he owned a house. Now, I'm not going to talk about what kind of house it was, but that's something that happened. This I find so interesting. In Scotland, and I think they still do this today, when you pay off your mortgage, you paint your door. So everybody knows that you're free and clear. And so this is also another one that I found really interesting. This is one of the gangsters that everybody liked because he would burn people's mortgages. And back in the day of paper, the banks would not know who owed them the money if they didn't have the paper. So Monopoly, I'm assuming everybody here has played Monopoly at one point in time, right? So it was designed to teach players about the broken nature of capitalism. But I think people still love that game. So this is another one of these really interesting houses. So India's richest person built this $1 billion home. It has 27 floors, 6 parking floors. So obviously he has a lot of cars that take up those parking floors. There it is, 168 cars. So you all have, if you bought a house, you know how many disclosures you have to sign when you're going through your closing. And one of them that they have in New York is that you have to disclose if you have a house that you think is haunted. So this one's kind of scary to me. So I just want to know how many people want to go to that top floor. But using prefabricated modules, the builders in China were able to build this 30-story skyscraper in as little as 15 days. But again, who wants to go to that top floor? All right, so just to break the ice, I thought that was a little bit of fun. But my conversation today is about what kind of tax deductions are you missing? And Ryan did not know what I was talking about. He just asked me to share some knowledge about real estate, but he kind of actually set the ground there for me and saying about, real estate is a great opportunity. It's one of the few remaining opportunities that you have to be able to make a difference in your tax return. Almost everything we have today has been, modified in such a way that unless you have a business or you own real estate, there's not a lot of deductions that you can take. You've got your 401k if you're working in corporate, or an IRA or that type of thing, but those are very limited in terms of how much you can invest and what you can do with it. Most of it's for when you retire. So if you're looking for something today that can create wealth and that can allow you to take advantage of the tax law, real estate is still one of the few things that are left for you. So this is one of the reasons I like it. So I like to start by talking about, or focus on, what kind of deductions are you missing? Because like Ryan said, if you're not using a CPA and you're doing it yourself, because, everybody likes to save a little bit of money. So, hey, I can just buy TurboTax and do this. And, what you don't know is you don't know what you don't know. Okay. So when you're looking at, for deductions and different things like that, maybe you don't understand all the things that are available to you. So we're going to delve into a few of those. So I do have a few cartoons in here, so I don't know if you can read them, but anyway, can you all see them? I don't have to read them for you. Okay. Okay, so we're going to start out with interest. And it's interesting, to me that seems like an obvious expense that you can deduct for, real estate, your investment property. Today, if you're living, you have a home that you've purchased and you have a mortgage on, you may or may not be able to take advantage of that interest on your Schedule A, because a lot of people our standard deduction in 2018 doubled. And so a lot of people went from being able to itemize to not. So, but with real estate, when you're actually having rental properties, you can, on that Schedule E, take the interest as a deduction. So you have to keep those two things separate, what you have, what you can do personally on your Schedule A versus Schedule E. And again, I find a lot of people don't make that differentiation to understand that they are different. So interest is definitely deductible. Employees and independent contractors. If you're getting started, you probably don't have employees. But if you're doing anything in terms of buying a house where you're not necessarily fixing and flipping, but you're going in and you're doing some remodeling, you might be hiring some independent contractors. So those are the type things, and I'm not going to get into a ton of, if you have to capitalize it or expense it, but there's different opportunities there for you to be able to take advantage of those, either through an increased value of the property or through expense on changes that you make to the property. Insurance. When you go to close your first property, there is so much thrown at you, and you don't a lot of times even realize that insurance that you're paying for that first year is right there on page 2 of that settlement statement. And so we're always asking for, if you come to our office, we always want to see those settlement statements because they have a lot of value. There are a lot of things we take off of that statement that we can use for your tax return. One of them is insurance. After the first year, you're going to either have it, if you, most people have those items, taxes and insurance escrowed. So we like to see if the 1098, which is your summary statement at the end of the year that you use to prepare your return, if it does not have those taxes and insurance pulled out and identified, we'd like to see the escrow summary that tells you, oh, hey, here is the breakout of where your escrow funds went for the year. So, and just to differentiate there, escrow is not a deduction, but how those escrow dollars are spent is the deduction. So insurance, taxes, those are the two typical things that are being escrowed. Travel. So I get asked this question all the time, what I mean by travel. So let's say you have a rental property you just purchased, and you're going there and you're making repairs, and you're going there and you're meeting contractors, and you're going there and you're doing work, and it looks, there's just a lot of driving it. All of a sudden you don't realize you have put a lot of miles on your card. Those are deductions. And so keep track of them through an app. There's some great apps out there that you can just turn on. It keeps track for you. At the end of the year, it spits out a report, and then you can use that on your tax return. Other travel, if you're someone that has a little bit of a portfolio and you're looking to do something maybe outside the area and you're traveling to do some investigative work, you need to be careful how much you use, but you certainly can use expenses like airfare and whatnot to, if you're truly doing a visit to look at properties or to investigate other opportunities. Casualty and theft losses. We all hope that none of you have this happen, but anybody ever have a tenant that didn't quite work out? No, I have. Okay, so I'll admit it. You do those background checks. They look great on paper, and in the middle of the night they leave. They leave their cat. We've had all these things happen. We had somebody leave a cat once, 2 cats, one was pregnant. So, different things happen like that. And so you have to go in and, rip out all the carpet or repaint the walls, those kind of things happen. And so hopefully you get smarter, and it doesn't happen very frequently. We only had it happen a few times where we had something that we actually did have one that we had put through insurance, but otherwise, you just want to make sure that you screen well, but those things are losses that you can actually take on your tax return for purposes of the property. Home office. If you're conducting a business, you're entitled to a home office. It's not as transparent on a Schedule E as it is on a Schedule C, but certainly you can look at the expenses that you use to conduct your business. What would those be? Your phone, your internet, and various things that supplies, things like that you need to run your business. Legal and professional help. Somewhere along the way, you might decide to hire that CPA, or you might need an attorney. And so, any attorneys in here? No? So they're great to get. Hopefully that you get one to come speak to you all because they have a lot of great advice. And so, we work hand in hand with a lot of attorneys in terms of helping individuals as their portfolio grows. As if they decide they want to put all their properties into LLCs or whatever, we work with their attorneys and help them in that process. All those things are deductible. So here's my favorite one, depreciation. So if you're new to real estate and real estate investing, one of the great expenses that you can take is depreciation. So what is that? We look at what you paid for the house, and let's just say you bought a house for $400,000. We use the assessor's website to determine what the land value is, and let's just, for easy math, let's say it's 25%, so that's $100,000. We take that $400,000 house, we subtract that 100, and we have $300,000 left that we use to depreciate over 27 and a half years. So that each and every year you get to take, and it reduces, again, your tax liability. One of the things that we work with some clients with, if they have commercial buildings or a larger portfolio or multi-units, duplexes, fourplexes, sometimes they'll do what's called a cost segregation. Are any of you familiar with that? Okay, great. So it's basically an accelerator on depreciation. Today we have some very good depreciation rules that are still in effect. Up through 2022, we could take 100% bonus depreciation on anything that had an asset life of 15 years or less. This year, 2023, it's phasing down now. We can take 80%. So in the next few years, it will go back down to the 50% level. So just again, another consideration. Repairs, this to me is a no-brainer. We kind of talked about that when we talked about casualty losses, but every home, whether it's a rental or a home you live in, will always have repairs. So those type things are, you can expense. If there's significant repairs, we call those remodels. Those probably need to be capitalized and depreciated. Okay, so this 2018 was a big year where we had the tax jobs and TCJA, bless you, TCJA, where the tax laws changed significantly, and they were very pro for real estate. Part of it was the president that was in office at that time, and this isn't anything political, it's just he was very involved with real estate, and so some of the laws that got enacted have been very proactive. So there are some elections that you can make on tax returns. One of them was you used to have to capitalize anything that was greater than a $500 amount. Well, today, that's so easy. Almost anything you do is $500. So one of the rules was to make some elections that allowed you to be able to depreciate or expense up to $10,000 in repairs as opposed to capitalizing it. So these were just a couple of the elections. You could make a de minimis election, meaning that if you had those kind of repairs, we could take that depreciation, or I'm sorry, the expense in that year and not have to take depreciation. So I have another moment here, cartoon moment. So anyway, if there's money to be had, usually you're going to pay tax on it. So that's kind of the rule of this game right here. So I've got some guidelines that I like to talk about for real estate investing. So the first one is being organized. So it doesn't take a lot to be organized, but it does take thought. So what do I mean by being organized? Have a system. Does that mean you have to go out and invest in software or some kind of scanner or this or that? No, but you need to be organized. The expenses people miss the most are those that get thrown away either through receipts. Today, most of us don't get receipts, but you have those credit card statements that you can use. Everything you can PDF and save into an electronic file. Our office is paperless, so what we do is we have everything saved in electronic file that we can go back and reference. So Ryan asked me, okay, what did you take on that property? I can look up and see how we came up with a number or what we used and what support he provided to us. And we use that as part of our documentation to be able to justify if for some reason somebody looked at his tax return and wanted to know what happened there. So it's important to document. It's important to keep track of what those things are. If you do use cash, and some people still use a little bit of cash around here, those are the ones that truly get lost. So be careful of and make sure you track those. Okay, so the second thing, and I kind of touched on that a little bit, is using a system for tracking expenses. So some of you, I get asked all the time, oh, should I buy QuickBooks? Should I buy, a property management software? What should I do? Well, I think just like anything else, you need to grow into what you're doing. So to go out and just buy a software to say, oh, okay, now I have this software, a lot of people don't know how to use it. And then it just sits there and you pay for it every month. So, find a method that works for you. Some people use Excel, and that's great up to a point. So, we just finished a return for one of our clients that we have a lot of clients that have multi properties, like plus a dozen. and we have the one I'm thinking of, he had a software he uses because he uses a property management software. He has 20-ish properties. And so for him, that's the best way to be able to track the expenses and activity. And then we're able to access this software. He gives us access to it during this time of year, and we make the adjustments that need to be made. And so he has something if he needs to go get a bank loan. So how many of you that have purchased properties had to get a bank loan? I think almost everybody. And, most people do finance at least their first few properties. And so what do they want? They always want to know, they want the documentation. So find a way to document and to use a system for tracking your expenses. This is one that I do think everybody should be serious about. Treat your real estate as a business. It is an expensive asset you're buying, and even though the bank might own a large portion of it, at least at the beginning, take it seriously. Treat it like a business. Consider whether you need to set up a separate entity or not. So what does that mean? That gets into the attorney side of things as to whether you want some legal protection or not. And so ask an attorney if that's something that you're concerned about. Set up separate checking account. I love this one because, again, if you for some reason forget, I had this transaction. If you're using one checking account, one credit card, not all the credit cards in your wallet, just one, it's easy to track. When you start spreading things out, and we call that commingling into your personal and maybe some other business or whatever, it becomes very difficult. And I know when people laugh, they've done it. So it becomes more and more difficult to go back and try and recreate what's going on. So, do some simple things like that. You can open a separate checking account in your own personal name. You don't have to have a business set up to, open up a checking account. And then finally, find a great CPA or an accountant or somebody to help build your team. So, I mean, who's on your team? You want a good insurance company, you want a good attorney, a good CPA. Those are the kind of people who can help you with this whole process. Real estate agent, real estate agent. Yes, I forgot about that. But there's many people that you can have on your team. So this is a building that is our office. I got this about, I want to say 10 years ago, not quite. Amazing deal. So, little backstory, I'll share this with you and then I'm going to open up for questions. But I was looking to buy, I'm trying to think how many years we've been there. I think we've been there 7 now. So I was looking to move outside of where we were renting. And my landlord, we co-shared, it was with an engineering firm, and they knew that. And so they were, very supportive in that. And I had started looking, and I really wanted a building where I could do something that, oops, we're going backwards. Sorry. But anyway, I wanted something that allowed us to be able to have more than ourselves as a tenant. So, 7 years ago, this property had some really gorgeous cheetah wallpaper in the lobby, and some of the best deals you will ever find either smell like cat pee or have unbelievable gaudy wallpaper. So in this case, we had, it was cheetah wallpaper. And by this time there were 3 offers that had come and gone. And I think a lot of people had a problem looking beyond the, what looked like a complete mess. And I think you have to be willing to look and have a contractor go in and help you, make sure you're, have a reality check. And, what's it going to take to get this building improved? And so I bought that property for $250,000, and I invested $250,000 in the remodel. So that property today is worth right around $1 million. So 7 years. You can do the math, but it's a good return on investment. So that's the example I like to use. It's my example. It's my story. I want to open it up for questions that you may have.
Say a friend of mine.
A friend of yours.
Had a rental for 9 years and hasn't depreciated it on his taxes.
Yeah.
Can you claim all that back?
Yeah, so we can. There's it's a code section 469. Not that you care, but it's you have to file an accounting change form. And that's form 3115. You're not going to want to do this yourself, but you can do that and catch up all that depreciation. That's probably the biggest thing we see when we have somebody come in that's been doing their tax return themselves, is they don't understand depreciation. And I mean, I understand. I mean, why you wouldn't? You're in the real estate business. You're not in the tax business, and so yes, you can. Yes.
I had approached talking to CPAs in your town.
Uh-huh.
Can you speak to what is the best time to resource those folks?
Yes.
Throughout the year?
Yes. So
What not to?
yes. So today was not that day. I'm just going to be honest. Anytime after October, this year it's October 16th, that's the last fight. From here until October 16th, we have the deadline tomorrow. We have a deadline at the end of the month for trusts, and we have the deadline on the 16th for individuals, for all those people extended. And so the real window is either May through July, because a lot of people go on vacation and they kind of go, oh, I've got plenty of time. And so that's when we have a window where it's really great to meet with new clients, or November and December. So most CPAs are not going to take you on January through April. We do not. We like to have a positive experience for our clients. We want them to feel like they understand what's going on, and we're crazy busy, and it's hard to give our best during that time of year to a brand new client. So we want that opportunity to be able to meet them, understand their needs, to be able to take care of whatever it is they've got going on. Yes.
When you do refinance at the end of the year and you pay some reserve interest, is that you gonna claim the tax deduction on that year or next year? Because at the end of the year, the interest is reserved for next year.
So reserves or escrows are not a deduction. So on that settlement statement I was talking about earlier, there's this whole section, usually it's labeled impounds. And so those are, 3 months worth of what's, interest or taxes. Those aren't deductions. What is the deduction is the actual interest. And so those show up for you either on a 1098. If it's a commercial building, you'll receive usually just a letter that'll tell you what those are.
So that will show up next year's 10.
It does. Yes. Good question. Thank you.
I have a little bit of a complicated question, I suppose, at least in my head. So, the co-mingling part, yes, I am very guilty of it. So I'm trying to be very organized now at this point forward. I have a property, a personal property in New Jersey, which I converted into a long-term rental.
Okay.
I set up a company in New Jersey, which is my property management company. So theoretically, my property management company is providing services to my rental in New Jersey.
Sure.
I haven't really paid the payment to my company for those services, but that's what I want to.
That's your idea. That's your plan. Yes.
Strategy, yes. So I suppose my point is that how I do my taxes, because my property, right, property is under my personal name, so I will do a 1040, do a schedule E. My company, Serene Property Management, under schedule C. Is that how I would do that? Is that how I do that? The payments would be like $200 for property management.
Sure. So you can do it that way. When you start to grow and have more than one property, you may want that property management, dependent upon how you truly want to use the property management company. And there's different schools of thought on that, is to actually set that up as an S Corp and then just keep your rentals on your Schedule E and report that way.
Okay. And then I guess the third portion of it, my certain properties is located in New Jersey. I'm opening up another LLC here in Colorado.
Okay.
And the member of my LLC, I'm getting into the legal stuff. The member is my certain properties. I'm just managing
Okay.
the property. So certain properties is my Schedule C, my business. Right, that I would be reporting on my Schedule C because I'm a sole member LLC. And then I would continue to report my long-term rental on my Schedule E as personal property.
That is correct. You report the Schedule E on your rentals, always are on your Schedule E.
Right, and then so services being provided from certain properties, right, to my rental property. So that would be all reporting my business, which would report on a Schedule C because I'm a sole member.
Right.
And the future state, as I build my business here in Colorado, then I would be
Let me just stop you right there. You don't need to set up a separate. You can use the same LLC regardless of the state. You just have to file in the state of Colorado or any other state as what we call a foreign entity. So that is very specific, and I can talk to you about that. We get into some of the legal stuff, which, again, I'm not an attorney and I'm not going to pretend to be. So, but I can tell you the tax structure of that. So,
One
Yeah.
more question?
I have a similar question. So I have a property in another state,
Uh-huh.
and I have an attorney who I think I want to fire. Tell me that I don't need to file, my LLC that owns the property doesn't need to file taxes in the state of Maine because I have a property manager that's actually using my property to generate revenue, and then they just pay me. The property
Okay,
manager is separate from me. They're
Right.
paying their own taxes.
right. You still have to report. Again, that property manager should be issuing you a 1099.
So do I have to, so state taxes is what my question is about.
Okay, so is the property profitable, or do you with, okay, so if it's profitable, which state did you say?
State of Maine.
Yeah, Maine is a tax state. That's why I'm asking, because we have the 7 states that don't charge tax, so you don't have to. But yes, you should be, and then you would get a credit in Colorado. So anytime you pay tax in another state, at least in our state, we get a credit for the tax that we pay somewhere else. So, oh, great. Thank you for all the questions. I'll stay around for a few minutes, but it'll just be a few minutes because we have a filing deadline tomorrow. So thank you all.
Thank you, Susan. I'll make a closing point here. You don't know what you don't know. That's got to be the strongest line when it comes to hiring a CPA, a lawyer, whoever it might be. The amount of money that a CPA will save you in taxes is more than worth the fee that they're going to charge you. Just in what they'll save you. That doesn't take into account the time it will save you, and the legality of getting audited, doing it wrong, having to do it again, forgetting depreciation. It makes a ton of sense if you've got real estate to hire somebody that knows all the ways that they can save you money. So thanks for coming out tonight, y'all. Meet somebody new, network. We've got the room till 8:30.